have a look at this chart over here. Now let me ask you, what is wrong with this chart? Take 3 seconds to think about this. The answer is this, is that there are too many support and resistance levels on the chart. And when you get too many support and resistance levels on the chart, you get analysis paralysis. This means that you are going to get conflicting information, right, that makes you feel at a loss at what to do. So for example, let's say, the market over here, it makes a pullback, a slight bounce, you want to buy, right? Because after all, oh, look at this area of support, Rayner. Okay, fine. And then the market goes up higher into this green level. So area of resistance, resistance, resistance. Now, do you sell at this price point? Are you going to nod your head and say sell? Okay, if you sell. If you sell, right, then think about this. Didn't you just buy a few moments ago and now you're selling? And if you were to sell, then how are you going to ride the trend up higher? How are you going to ride the wave? Well, you can't, right? And that's the problem with having too many areas of support and resistance on the chart, is that you're going to get analysis paralysis, right? Every decision that you make, right, somehow there's another piece of evidence telling you that you are wrong, and you always feel lost and confused. So if you feel anywhere along those lines, don't worry, because in today's training, you will learn, number one, why support and resistance, they are not equal, because there are times support is more powerful than resistance, and there are times resistance is more powerful than support. So you need to identify the right times to know which to pay attention to. So this way you get less analysis paralysis, less confusion, less frustration. Number two, how to draw accurate support and resistance levels so you can better time your entries. When exactly should you buy when the price comes into support? Because I'm sure there are times when the price comes into support, you thought, man, it's a buy. And when you buy, the price collapses. Why is that and how can you avoid it? That's what we'll cover in this section. And finally, I'll share with you a support and resistance trading strategy to profit in bull and bear markets. And it works, right, whether you're trading the stock markets, the forex markets, or even the crypto markets. Sounds good? Then smash the thumbs up button and let's get started. Now, the first thing to understand is this. Support and resistance, they are not equal. I don't care what other traders say, support is support, resistance is resistance. No, they are not equal, because in certain market condition, right, one is more powerful than the other. Let me explain. So if you look at this chart over here, this is the chart of dollar against the Japanese yen. This market is in an uptrend. So let's say, for example, if you were to draw resistance, right, this is not how I would usually draw, but just follow along with me for now. Let's say this is resistance, resistance, resistance. Okay, and then this is support, support, support. All right, let me ask you, in this market condition, is support stronger or resistance stronger? Let's analyze it, right, step by step. So this is over here is resistance. You see the price breaks above resistance. This over here is resistance, price breaks above resistance. This is resistance, price breaks above resistance. Now what about support, right? This is support, price didn't break below it. Support, price didn't break below it. Support, price didn't break below it. So as you can see, in an uptrend, resistance tends to get broken. And it is kind of like logical, right? Because as you know, market is in an uptrend, it means a series of higher highs and higher lows. This means resistance should get broken. So this means, right, in an uptrend, support is more powerful than resistance because it tends not to get broken. Yeah? So understand support and resistance, right, they are not equal, right? Let me give you another example. This one over here, this stock is Adobe. This market is in a downtrend. Let's say you draw resistance, resistance, resistance. Let's say this one here is resistance. And this is support, support, support. Let me ask you, is support stronger or resistance stronger in this market structure? And the answer is this. Resistance is more powerful in a downtrend, right? If you look at support, right? Support is broken, right? Price then breaks down lower, breaks support. And if you ask me, if the trend continues down lower, this area of support is likely to get broken as well. So when the market is in a downtrend, resistance is more powerful, it's stronger. So understand this concept. So now the question is, how do you actually draw support and resistance correctly? Now, you might be thinking, but Rayner, what about range markets, man? Is support stronger or resistance stronger in a range market? Great question, and I'll answer it in the later part of this training. But for now, let's talk about how do you actually draw support and resistance like a pro, right? So have a look at this chart over here. You can see that this market is in an uptrend. And as you know, right, in an uptrend, support is stronger. So this is where we want to give it more attention. So let's learn how to draw support in an uptrend. So why don't we want to draw resistance in an uptrend? Because as you've seen, right, resistance tends to get broken in an uptrend. So we're not too concerned about it. Let's focus more on drawing support. Okay, and the way I'll do it is that I'll pay attention to the two most recent swing points. What do I mean by this is that this is what I call a swing point. This is what I call a swing point. This is a swing point. This is a swing point. So I'll pay attention to the two most recent swing point when the market is in an uptrend. I'll explain why shortly. And how do I draw support is like this, right? So you can use a rectangle tool or a line if you prefer, right? But for those of you who are new, I recommend drawing it as a box because support is an area on your chart. And what I would like to do is to get as many touches as possible, right, at my area of support. So for example, I'll draw it, this one possibly something like this. Okay, why do I draw this box in this manner? Because I got this one touch over here, I got the other touch over here, and this touch over here. So I got 3 touches over here. So I like to get as many touches, right, into this area of support. So another example, this one over here, I would draw this probably something like this, okay? So for this area of support, you can see, again, I draw it in this manner because I got multiple touch. I got this one over here, previous resistance, which became support, this area of support, and then this area of support as well. So this is what I mean by, drawing your support to get as many touches as possible into the box, into the zone. Now, what about this level here? And what about this level here? Why are we not drawing support at that level? Good question. And the reason why I don't draw support at those levels is because if you think about this, let's say if the market comes down lower into this low over here, let's say into this area of support, at this point, I am not interested to buy. Why? And the reason is simple. If you think about this, if you visualize the chart, if the market were to reach this point, this market is no longer in an uptrend. It's probably in a downtrend. And I'm not interested to be a buyer in a downtrend. I like to trade with the trend. Of course, for those of you who are counter trend traders, that argument might not be valid. But for me, I like to trade with the trend. And if the market reaches this low, this market is in a downtrend and I don't want to be buying, even though the price is at support. I'd rather much be selling. So this is why I don't draw, every swing level as support on my charts, because there's no point to it. Make sense? So let's have a look at one more example over here. So this market now is the inverse. It's now in the downtrend. So how do we draw our resistance, since you know that resistance is more powerful in a downtrend? So same concept applies. We like to get as many touches as possible. So this is going to be one of it here. Okay, so you can see over here. This one over here, we got quite a number of touches, right? 1, 2, 3, 4, 5, 6 touches, right? So my zone, my area of resistance will be here. The other one would probably be somewhere here. Okay, so you can see that over here for this second one, I got 1 touch, 2, and 3 over here. Now, what about this one and this one over here? Why am I not drawing this? Again, if the market were to rally up higher and retest, let's say, this highs over here, at this point, right, let me ask you, is the market in an uptrend or a downtrend? At this point, if the market gets to this price level at 34,000, the market is probably in an uptrend. I'm not interested in shorting uptrend. So this is why I don't draw every level as my resistance, because it's not relevant. Make sense? So now, next question is this. How do you trade support and resistance like a pro? So now you know how to draw support and resistance, right? How do you actually trade it like a pro? So here's an example. If you look at this chart, you can see that this is an area of support, right? And traders might be tempted to let the price comes into support and then just buy over here. But for me, I don't really like to do that, because I'm sure you've experienced before. When the price comes into support, you buy, and the next thing you know, it collapses through support and goes down lower. So what I like to do instead is to actually wait for some sort of a confirmation, otherwise known as an entry trigger. And by the way, if you are enjoying this training so far, smash the thumbs up button. If not, hit subscribe. Okay, moving on. What is an entry trigger? An entry trigger is simply a specific price pattern to help you time your entry, to tell you, for example, hey Rayner, it's time to buy. So we are looking for that specific price pattern to tell us that, hey Rayner, it's time to buy. So what price patterns can we use, right? So there are a few common ones, but two I want to share with you today. One is called the hammer. So what is a hammer? So for those of you who do not know, a hammer simply tells you that the buyers, they are temporarily in control, because this is the opening price of the hammer. So let's say if you look at this hammer, it's on a daily time frame. Okay, this is what it's going to mean. This is where the market opened. This is where the market has closed. And this is the high of the day. And this over here is the low of the day. So the story goes something like this. So when the market opened, right, the sellers took control and pushed the price down lower near the lows of the day at the maximum pessimism, right? What happened is that the buyers, right, they will push to a corner, and then they found the strength, they found the courage, they found the conviction and to retaliate and push the price higher to close near the highs of the day. So this is like, for those of you who watch Marvel Endgame, right? Captain America is all alone facing Thanos' army, and you know that, that's the point of maximum pessimism. You thought, oh man, that is the end. Then what happens? Right, then that's where, I think his friend, right, Sam, right, the Birdman comes in. Then the portal starts to open. Black Panther appears. Wakanda forever! Right, and then of course, they got into a war. The good guy won the bad guys, right? So this is kind of like similar story at a point of maximum pessimism, right? The buyers took control and push the price higher to close near the highs of the day. So as you can see, this particular price pattern tells you that the buyers, they have temporarily won the war. They are in control for now. The other price pattern I want to share with you, or candlestick pattern if you want to call it, is called the shooting star pattern. So you can see this over here, again, is the opening price. this is the closing price. So one thing to note is that a hammer and a shooting star, right, the opening price and the closing price, they are opposite, right? So this is for hammer, the opening price is here, the closing price is here. Okay, so you can see that the close is above the open, whereas a shooting star, the close is below the open, right? So this is just basic candlestick knowledge. And as usual, this is the high of the day, and then this is the low of the day. So the story of a shooting star pattern goes something like this. When the market open, right, the buyers, they chiong, they quickly push up the price higher near the highs of the day at maximum optimism. Why? Celebrating, right? Victorious, right? Then suddenly, right, the sellers, right, they, maybe overdose with steroids, they got really strong and push the price lower, closing near the lows of the day, signaling you that the sellers, they are temporarily in control. So this is kind of like, at a point of happiness, maximum optimism, and your whole world suddenly come crashing down. Yeah. So this is like, you didn't study for your exam, and then you go back your exam results. You got an A, you're over the moon, right? Wow, A. And then you only realize it's actually A for absent. Your whole world come crashing down. So same for this shooting star pattern, right? So these are two very popular or useful entry trigger techniques that you can use to time your entry. And before we look at some examples, I want to walk you through a recap, right, to what you've just covered. Number one, support and resistance, they are not equal, because as you've seen, right, when the market is in an uptrend, support is more powerful, and when the market is in a downtrend, resistance is more powerful. Next, to draw support and resistance, I want you to focus on the two most recent swing points, because those are the two most relevant area on your chart, right, for buying opportunities. And finally, you can use entry trigger like, the hammer pattern or the shooting star pattern to help you better time your entry. Okay, now let's have a look at some trading examples so you can see how you can use the concepts that you've just learned, right, to trade the market. So you learn a support and resistance trading strategy that allows you to profit in bull and bear markets, right? So first thing first, remember, right, what is this market structure? You can see this market is in an uptrend, and when the market is in an uptrend, we want to be buying as much as possible at support. So let's identify our area of support, right, on this chart. So if you ask me to draw it, I'll probably have this one here, okay, and possibly another one over here. Okay, so you can see that these are the two most recent swing points, right, on the chart. Next, let's see what happens next. So what my plan now is that if this were to happen, right, I'll be looking for buying opportunities, right, at this first area of support, or possibly this second area of support. If the price comes down to here or here, it's unlikely I'm interested to look for buying opportunities. I'll probably look at some other markets instead. So let's see. So the market heads down lower, comes down into this area of support. Let's see what happens next. Now over here, we have a hammer. So if you remember, a hammer tells us that the buyers are temporarily in control as they have managed to, push the price and close near the highs of the day. So this is a valid entry trigger to go long. So let's say we go long on the next candle open. So I'm just gonna, let's say, have a line, right, to signal that we go long on this next candle open. Let me just remove this box, right, so I don't confuse you. Okay, so now this green line represents our entry price, right? Okay, so if the market opens the next day, right, this is our entry price. Now, what about our stop loss? Our stop loss is something that I've not covered yet, but generally, when I set my stop loss, I like to have it a distance below the area of support. I don't like to set it just over here because the market could possibly come down lower, hit my stop loss, and then reverse up higher. How many times have that happened to you, right? So this is why we want to set our stop loss usually a distance below the lows. And one way to go about doing it is that we can actually use the ATR indicator to help us with this. So just search ATR, pull it out. I typically go with a 20 period ATR and SMA. Okay, so what we're going to see now is that the ATR value is 1.221. So how do you make use of this information? So very simple. This tells us that over the last 20 trading days, this currency pair, Swiss franc against the Japanese yen, moves an average of about 122 pips a day on average. So what we want to do is to identify the lows over here, right, at minus 1.221. So what is the lows of this candle over here? So if you realize the low of this candle, it's 137.15. So I'm going to take 137.15 minus 1.22. Okay, so if I do that, I get 137.15 minus 1.22. That gives me a value of 135.93. Pardon the handwriting. So 135.93. So that will be my stop loss level. So I'm going to highlight that on the chart so you can see it. So over here, let's change this to red to signal that that is our stop loss. 135.93. So that is my stop loss. Okay, so now just to reiterate, right, why this level is our stop loss is very simple, because this low over here, let's say this low, let's call it X, right, we minus 1 ATR. Okay, you know the value of this low is about at that point in time was about what did I say? Can't remember. But the low over here, right, is pretty much 137.15, right? And we minus off 1.221 as shown over here, which is one ATR value, and that gives us a stop loss of 135.93 as shown over here. Okay, so that's how we derive with our stop loss. Now, what about target? So many ways to go about setting your target, but for simplicity's sake for now, since this is the first example, we usually can set our target just before the recent swing high. So let's just change this to blue and set this as our potential target profit, right? So because this is, again, is an area of resistance, price bounce off once, come down lower, bounce off second time, come down lower. So maybe a third time it could hold up, right, and possibly reverse down from here. Who knows, right? Although this market is in an uptrend, it doesn't mean that, you know, the price will always go up forever. So this is this swing high over here could be a good reference point for us to take profit, where sellers might come in and exert some selling pressure over here. So this would be a potential level to set your target. Now, if you want to assess this from a risk to reward standpoint, you can actually use this particular tool over here. Click long positions, and you click this over here. So this one over here, you should put it at your entry point, and this one put it to your stop loss level. This one over here, put it to your take profit level. And you can see that over here, if you assess this potential trade, it's a risk to reward of 1 to 1.14. This means you're risking $1 to potentially make $1.14 for this particular trade. And just to walk you through this particular trade, right, what happens? Let's see. Eventually, the market did probably would have hit our target over here on this candle, right, giving us a profit. So if just to play safe, right, let's say you know there's some slippages, you didn't get filled. Eventually, this candle would have gotten you out with a profit for this particular trade. So this is an example of how you can actually use support resistance, right, to time your entry, right, and to identify, you know, trading setups in the market. Okay, moving on, right, another example, and this time around we will move to the stock markets. This is the stock of CHK, and again, same principle applies. This market is in an uptrend. So in an uptrend, we want to look for buying opportunities near support. So if I were to draw support, right, what's interesting is that over here, I'm seeing this is an area of support. Okay, and I'm seeing another area of support just shortly, I think below here, there's another one over here. So they're pretty close in this particular example, right? So let's see what happens next. So in this case, the market broke below the first area of support. Will it reverse? Let's see. Nope. Now retest our second area of support. Then now over here, we have a very strong bullish price rejection, right? So again, this is not a hammer, but this is what I would call a false break setup. Why do I say this is a false break? Because you can see the market took out these lows, over here on this candle. It broke both area of support. So at this point, right, many traders will think that the market, man, is going to collapse, going to crash. It's a bear market. But what happens next is that the market, the next day, reverse strongly and close back above the high. So if you think about this, the story behind this price pattern is similar to a hammer, where at a point of extreme pessimism, the buyers, you know, step into control and push the price higher, closing near the highs of the day on this candle that you see over here. So although this is not a hammer candlestick pattern, this story behind it, if you read candlestick pattern, is very similar to a hammer. So this to me is a sign of strength. Buyers are stepping in, about to push the price higher. So what I'll do is, again, I'll look to enter on the next candle open. So for now, I'm going to remove these two levels to make it clearer for you to see. So the next candle open, this is going to be my entry point over here. This will be my entry. I'll put this to green. Okay, and for stop loss, again, I will set it a distance below this extreme low over here. I'll set it 1 ATR below it. You've learned how to calculate it. I won't go through it again. So if I were to estimate where my stop loss will be, probably I'm going to guess it's going to be somewhere here. Okay, I'm not going to do the ATR calculation, right? If you want, you can refer to the previous example, which I just did. And as for target, right, I would say this highs over here, right, would be a relevant level to consider taking profits, because this is where sellers could come in. This area over here is where sellers could come in and push the price down lower. Now, one thing to add is that if you look at this chart, right, we all can agree that this is in an uptrend. And if we were to, you know, kind of like take profits over here, right, we might be leaving profits on the table, because the market could go up higher, break out higher before it reverses down on a pullback. So now the question is, how can we know where is this high that the market could reach to, so we can kind of like maximize our profits, right? How do we kind of like define how much more the market will exceed these highs, right, before it reverses or make a pullback? So in other words, right, how can we objectively identify this high over here? So what you can do, right, is to use what I call a Fibonacci extension, right? So the way to go about it is to share with you first is that, number one, you can look to take profit before this highs. Maybe if you have, let's say you bought 100 shares of CHK, you can sell 50 shares, right, at this high. So I book some profits if the price reaches that high. So let's see what happens. Okay, so in this case, you can see that the market did Pull back a little bit. Still pulling back. Now seems to be going higher, higher. Pulling back a little bit over here. And eventually, reach our first target over here. So at this point, we have sold 50 shares of Chesapeake Energy. So what about the remaining 50 shares? So again, the remaining 50 shares, right, we could sell it, right, as the price somewhere about here, right, at this point where, because if you look back at this price action of this chart, right, the market tends to break out of the highs before it makes a pullback. For example, this is the highs, the market breaks out of the highs over here, then it pulls back. This is a new extreme high, market breaks out, then makes a pullback. So the thing is that how can we kind of like predict, right, how much further the market can move in our favor to kind of maximize our profits? So this is where the Fibonacci extension, right, comes into play. So you go look for your Fibonacci extension over here, select this one, trend-based Fib extension, and you draw it, right, for this particular example, it's from this low to this high and back down again. Okay, so if you look at the chart, right, you can see that we have a few levels popping up. We have the 127 extension over here. We have the 162 extension and the 2.0. So again, to be conservative, right, you can look to take your remaining shares of this stock, right, CHK, at this 127 extension. So you can set your second target, right, at around this level over here. So let's see what happens next. So in this case, the market eventually pull back a little bit and eventually reaches our second target over here. So this way you have 50 shares of this particular stock, right, Chesapeake Energy, exiting at this swing high, and the remaining 50 shares at this 127 extension. So this is how you can kind of like, get the most bang for your buck, right, where you have certain number of shares, to take at a second target profit objective. Okay, pay attention. So if you recall, right, earlier I said that what about range markets, right? Support stronger or resistance stronger? So I want to tackle that in this section over here. So if you look at this chart over here, this is the chart of Canadian against the Japanese yen, the 4-hour time frame. You can see that this market is pretty much in a range. Okay, so the question is, man, Rayner, is support stronger or resistance stronger in this example? So the thing to find out is, here's the tip for you, is that you want to refer to the higher time frame and see what the market is doing. Right? So if you know that the higher time frame is in an uptrend, then in this case, in this range market condition, I want to be as much as possible buying at support. And if the higher time frame is in a downtrend, then as much as possible, I want to be selling at resistance. So this is how we gain an additional insight, right, to see what the higher time frame is doing, to then determine, right, whether in this range market condition should we be looking to buy at support or sell at resistance. So as you can see, this is the 4-hour time frame. Let's go up to the daily time frame and see what this market is doing. So on the daily time frame, you can see that this market is actually in an uptrend. So if you know the market is in an uptrend, then guess what? You want to look for buying opportunities at support. So this is where you can again go back to your 4-hour time frame, right? And you have identified that this over here is a range. Okay, it's a range over here. You can then look for buying opportunities at this area of support. So again, you can use, your entry trigger, your candlestick patterns that you are familiar with. So let's see what happens next. So in this case, the market come down into support. Seems to break below support. But as you know, right, when the price breaks below support, sometimes it could just quickly, just reverse up higher. So let's see. So in this case, it starts to stall. Close lower for the day, slightly lower. Then over here, with a strong bullish reversal pattern. This is what we call a bullish engulfing pattern again, right? This pretty much means that the buyers, right, they are temporarily in control as they have managed to, push the recent down move over here, right, as the sellers are trying to push the price lower. In one candle, right, the buyers stepped in, right, and reversed all the losses and closed near the highs of this 4-hour candle. So again, this, right, could be a valid entry trigger to go long, right? So let's say you enter on the next candle open. Okay, let's say I will draw over here. This is the opening price. Your entry. I'll just change this to green to signal your entry. I'll remove this box so you already know it's an area of support. For stop loss, again, usually a distance below this low, let's say somewhere over here. So as you know, right, you can use the ATR indicator to help you determine your stop loss, but I'm not going to calculate it since I think you should be familiar by now. Now, what about target, right? So if you look at this chart, this is a range market, right? There are numerous areas on the chart, right, where you can look to take profit. I think this is one over here, this swing high, and possibly another one over here. Okay, so let's walk through and see what happens next for this market. So as you can see, the market starts to head higher. Okay, I'll just play this a little bit faster. So let's say, for example, our first target, let's say we put it over here. This is our first target. I'll just change this to blue. Let's say this is our first target. Okay, let's see what happens. You can see that the market now starts to reverse back to our entry point. So at this point, right, many traders, they would get panic. Right now, market is reversing. Let me exit the trade now before this trade turns into a loser. But you have to understand that the market doesn't usually go up in one straight line. If you look at this chart, right, the market goes up, makes a pullback, goes up, makes a pullback, goes up, makes a pullback, goes up. It is not surprising to see that, before the market, let's say, reaches your target over here, it's going to go up, makes a pullback, goes up, makes a pullback, goes up, makes a pullback, then goes up, reach your target. So again, you don't expect the market to, sometimes it could, immediately reach your target, and of course, right, that's an easy trade, easy to hold, great. But there are many other times where the market goes up, pulls back, goes up, makes a pullback, and toils with your feelings. So you have to be prepared for that. So in this case, this is one example of how the market, seemingly, seems to be moving in your favor, and then suddenly makes a pullback back to your entry point, and now you get freaked out. So a lot of traders will just exit this trade for break even, and whew, relief, right? Oh, then this trade didn't turn into a loss. But if you look at it, right, that isn't really respecting the market price structure, because you know that market doesn't really go in one straight line, goes up, makes a pullback, etc. So let's say you are a mature trader, you didn't just quickly exit your trade. All right, so let's see what happens next. So you can see the market then starts to retest these highs. Okay, so at this point, okay, I would say it is not wrong if you look to exit a portion of your trade at this highs. Why is that? Because you now know that when the market heads down lower and then it retests back this highs, right, this could be an area of resistance where sellers could come in and push the price lower. So this is a swing high. So if you, let's say you long one lot of Canadian yen, you can sell 0.5 lot, right, at this high over here. I think that's a decent move to take, okay? And then you can have the remaining 0.5 lot, maybe have it at this level over here, or if you want to be more aggressive, you can even shift it to this highs over here. Okay, so let's say we just leave it at this level over here and see what happens next. Okay, so in this case, the market, we've exited half our position at this highs. Let's see what happens. So once you exit half a position, right, you're going to be psychologically easier on you, because let's say if the market does reverse back lower, right, and hit your stop loss, right, it's not going to be a loss for you because you already book some profits at this highs over here. And if the market hits your stop loss on the second half of your position, you probably end up break even on this trade. So psychologically, it's going to be easier to hold, right, once you exit a portion of your position. So in this case, the market, as you can see, again, it collapsed down lower back near to your entry point. But again, you wouldn't be too shaken out. In fact, you'll feel a bit relief, right? Because you've already exit a partial profits, right, at this recent highs over here, okay? So let's see what happens next. So you can see that the market starts to, flirt with your emotions, goes in your favor now. Then it starts to collapse back lower, now below your entry point price, right? So at this point, you're prepared to get stopped out. If you do, you probably end up with an overall break-even trade. So let's see what happens. So in this case, the market then respect this area of support, starts to show signs of reversal back up again. And play this a little bit faster. Eventually reaches your target over here. So at this point, you can see, right, the trading is simple but not easy, because at this price point, right, many traders will think, oh man, this market is consolidating. What if it breaks down lower, right? That could happen. So again, this is up to you to kind of like to actively manage your trade, right? If you think that, man, if the price reaches back above this highs, I want to exit, the remaining half of my position, I won't say it's wrong, because you're kind of like respecting the current price structure and then managing your trades accordingly. But again, if you are the type of trader that is very disciplined, I already book some profits on the first half of the position, I want to ride the second half to my second target over here, again, that is fine as well. So you've got to journal out your trades, right, and to find out, what works best for you. So hopefully in this example, I know it's a little bit detailed. I want to walk you through actually in this example to show you the different type of active trade management strategies, right, that you can take to trade the markets, because trading, it is simple but not easy. Yeah. Yoo-hoo! Right, so now pay attention, right, because what I'm about to share with you, right, is advanced stuff that I believe 99% of traders, right, don't even know about it, right? So we're going to deal with multiple time frame now. So if you don't really understand what I've covered so far, then review back this section, because we are going to use what we have learned so far and take things a step further. How do you actually fine-tune your entry, right, to risk $1 to make $3, $4, or even $5 or more? So thereby can see improving the risk to reward on your trade. So first thing first, right, again, we are going to go down to the weekly time frame in this case, right? We are going to use multiple time frames to help us time our entry, but again, we are using the same principles that you've learned earlier. This market is in a downtrend, right? So in the downtrend, you know that you want to identify your area of resistance. So the recent area of resistance that I'm seeing is possibly this one over here. Okay, why this one? Because if you look at this, right, this is where previous support, price break below support, which could now become resistance. Okay, so let's see what happens next. So this is the area of resistance that I've highlighted. So what I want to do is to let the market come in towards this area of resistance. Okay, so now it's inside over here. Then I want to go down to a lower time frame to help me fine tune my entry. So instead of, what most traders will do is that they let the price comes into resistance, then maybe give them a shooting star pattern over here, right? Then it goes short, stop loss above this highs, target maybe at this low. So you can see that if you were to do that, at best you get is 1-to-1 risk reward ratio. But how can you use this same analysis, right? And instead of getting a 1-to-1 risk reward ratio, you get maybe a 1-to-3, a 1-to-5 risk reward ratio. here's how, here's the magic. Okay, so what you want to do is to go down to a lower time frame like the 8-hour time frame. Okay, so now at the 8-hour time frame, this is what you're seeing. And on the 8-hour time frame, you can see that this market is approaching this area of resistance over here. Okay, so what you're looking for is for possibly getting a bearish price rejection to help you time your entry. So let's see what happens next. So in this case, market heads down lower. Okay, so what we're looking for is to see if the market can head up higher and then get rejected, close back below this area of resistance. Because when that happens, right, we can then use this as an entry trigger to go long, right, and taking cues, right, from the weekly time frame bearish, direction. Okay, so let's see what happens. So in this case, you can see that the market, yep, there we have it, right? Notice this candle over here. It's small, but still, it's a bearish price rejection. The price tried to break out higher of this highs. This candle tried to break out higher, only to close near the lows of this 8-hour time frame. So this is a entry trigger to go short. So what you can do is, again, let's say you go short on next candle open, right? Let's say the next candle opens over here. You go short. Let's just change this to green color to signal as our entry. I'll remove this box resistance because you already know what it is. Then let's say our stop loss, right, is a distance above this high. Let's say 180 or above it. So let's say change this to red. This is our stop loss. Okay. And what about target? So here's the thing, right? As you've seen, right, sometimes trade management is not the easiest thing. As in our previous example, the market can move in your favor, go against you, moves in your favor, go against you, right? And if it does hit your stop loss, you go, you get crazy, right? You want to kill yourself and jump down the building. But please don't do that, right? So you can see that trade management, right, is critical, right? And the market sometimes doesn't just move in one straight line and reach your target profit. It can mess with your emotions, make you go crazy, make you go, right? So what you want to do is that I suggest is for new traders is to have two parts. With regards to your take profit, you can have a TP level 1 and a TP level 2. TP stands for take profit. So to make your life, or to make your emotions easier to manage, you can have a first target over here, right? Just before this recent swing low as your first target. Okay, so I'm just going to change this to blue as your first target. So let's say, for example, in this case, it's New Zealand dollar. Okay, let's say you're short one lot of New Zealand dollar. You can set this first target, right? TP1, right? And, exit 0.5 lot at TP1 over here at this blue level. Okay, let's see what happens next. So in this case, market is kind to us, pretty much reach our first target relatively quickly. So at this price point, if the market, let's say it were to reverse and hit our stop loss, this trade will probably be just a break-even trade because the first half of your position has already, booked a profit. So now, at this point, right, let me just bring you back to the weekly time frame and see where you are. So if you look at the weekly time frame, right, this is the green level is where you actually shorted the market. So you actually short, right, at the upper wick of the weekly candle. And that's really the secret, right, to entering at the wick of a candle, right? You got to use multiple time frames to help you better time your entry. And I'm pretty sure that 99% of traders, right, do not know that this particular technique exists. So if you think this is awesome, smash the thumbs up button. If not, hit subscribe, yeah? So carrying on, right, you can see that this, on the weekly time frame, the market is in a downtrend, a series of lower highs, lower lows, lower lows, lower lows. And the market tends to, break below the swing low. So again, over here, this low, market break below the swing low. This low, market break below the swing low. So if you ask me, the market, there's a good chance it could break below this swing low, right? And could, give us a favorable risk to reward on the trade. So how can we maximize our profits, right, in this instance? So again, one way to go about is that you can use the Fibonacci extension technique I shared with you earlier. You can, use the 127 extension and project where the 127 extension might be over here and then use that as your second target profit. Alternatively, right, you can also, trail your stop loss and to ride the trend down lower and to, see how much further the market can go. And this is something that I want to talk about since I've not, discussed it yet. So on the 8-hour time frame, what you can do is, again, okay, so you need to have a second target, right, where you expect the market to move. So once it reaches your second target, right, and then you can, throw in a trailing stop loss to ride the move down lower. So let's say, for example, we see that this is an extreme low over here, and we expect the market to retest these lows over here, right? So let's say we want to see if the market will retest these lows first or hit our stop loss first. So let's see what happens. Okay, so let's go. So in this case, the market pretty much reach the lows over here. But remember, if we want to trail our stop loss, right, we cannot exit the trade at this lows over here, because if you were to exit, then there's no more trend to ride. So what you can do is, at this point, is again, you can add in a moving average, like, a 50 period moving average, a 20 period moving average, depending on the type of trend that you want to ride. So let's say we go with a 50 period moving average, right, which is this blue line over here. So you can see that what happens is that for this trailing stop loss, you'll tell yourself, if the market goes up higher and closes above the 50 period moving average, only then will you exit the trade. If not, you will continue holding this trade, right, and see how much further the trend can move in your favor. So let's see what happens next. So in this case, you can see that the market have a slight brief rally, and the 50 period moving average is coming down lower as well. So over here, you can see the market right, broke down below this lows, nice, but again, you're not exiting your trade yet because you're trailing using the 50 period moving average over here. So you only exit the trade if the price breaks and close above the 50 period moving average. So in this case, you can see that over here, still heading down lower, nice. And then almost at the 50 period moving average, but has not closed above it yet. So we are still holding this short position. You can see that's quite a long wait. And finally, the market has break and closed above the 50 period moving average. So at this point, you exit the second half of your position on New Zealand dollar. So you can see that for this particular trade, right, you exit first half at this blue line over here, your first target, and your second one you exited at this portion over here. So you look at, if you assess it right from a risk to reward standpoint, you're possibly risking $1 to make, $3 or more. Yeah. Okay, one last example before I go. Right, boom shakalaka, boom shakalaka. Boom, right? So I'm really feeling it, right, as I produce this this content here today, because it feels like, man, this just feels really good. It feels really awesome because this is, I would say, is the best of the best that I can give out, right? So anyway, moving on, right? So let's have a look at this chart. This chart is the 4-hour time frame, Canadian yen, and it seems like the market is in a range. And as you know, right, if the market is in range, do you buy at support or sell at resistance? The clue is the higher time frame. So if you look at the higher time frame, the daily time frame, Swiss franc against the Japanese yen is in a uptrend. So as much as possible, I want to be buying at support. So on the 4-hour time frame, okay, this might seem like a range market, but you know that support is likely to be more powerful. So let me buy, or rather look for trading opportunities at support. So I'll draw this area of support over here. Okay, so let's see what happens next. Market come into this area of support, and then we have a strong bullish reversal pattern, right? So this isn't a hammer, but if you look at the price action, you can see that the story is very similar to a hammer, right? This candle is a down candle closing near the lows. This candle is a down candle, right, closing not near the lows but in the middle of the highs and lows of the candles range. And then this next candle, buyers stepped in and pushed the price higher, closing near the highs of this time period, which is the 4-hour time frame. So again, right, this to me is a valid entry trigger because this is what I call a false break, where the price tried to break below this lows, break below this lows, break below this lows, right? You can see over here, only to reverse up higher, right? Telling me that there isn't any more selling pressure. That's why the price have difficulty breaking down lower. So what I'll do is that I will look to enter on next candle open. Okay, so somewhere over here, I'll change this to green color as my entry. And by the way, this is actually a live trade that I took on my own trading account. So I'm walking through the same process, right, that I had when I took this trade. I'll remove this support area first to make it less cluttered, right? My stop loss was somewhere about here, 1 ATR below this low, so somewhere about here is my stop loss. I'll just change this to red, okay? And as for target, right, at that point in time, right, my target was actually at this recent swing high over here, this most extreme high, right? So that's my first target. So I had two targets in mind. Reason being is that if you look at the daily time frame, you know that this market is pretty much in an uptrend. Okay, it's in an uptrend. So I want to have my first target over here, and my second target is that if the market breaks above this highs and continue higher, I want to trail my stop loss, right, and to ride the uptrend up higher. So that's the way I was planning this particular trade. So let's see what happens next. On the 4-hour time frame was my entry, and you can see that the market reversed against me, the next candle, and then immediately, right, or relatively quickly hit my stop loss, and then close back up higher. So this is actually a losing trade for me. And as you can see, what happened next is that the market, it did eventually, continue higher, but I was already stopped out of the trade. So the reason why I'm sharing this with you is that whatever I'm sharing with you here today is not the holy grail. It's not foolproof. You will have losses along the way. Plenty of losses, in fact. So my hope is that you can take the strategies or concepts that I've shared with you and do your own validation, do your own testing to make it, to mold it, to fit your own trading, right? Regardless of what markets you're trading, what time frames you're trading, to use these concepts, right, and to develop it and tweak it for your own. Okay, so that's kind of my hope over here, and also to let you be aware that there's no 100% winning rate. There will be winners, there will be losers along the way. And before I go, if you want to learn more about trading, support resistance, price action trading, you can get a copy of this book called Price Action Trading Secrets, right? We dive deep into candlestick patterns, support resistance, trading breakouts, pullback, etc. I'll put the link somewhere below this video so you can get a copy of it. And with that said, I wish you good luck, good trading, stay safe, talk to you soon.